All right, everybody. It is Wednesday, 9 o'clock, and Leon and I are here to talk to you today about something everybody wants to know: how to make $1 million. It sounds like, okay, you guys are making it sound very casual right now. We're about to talk about $1 million. Yeah, right. No, we're going to talk about what it takes to make $1 million. So, as Leon tells you why we chose this topic, I'm going to do a little bit of housekeeping.
Yeah, so we did a podcast a few weeks ago about interest rates, and people that follow IEA know Brent and I are proponents of getting your money out of interest rate bearing accounts. Uh,
Tradition, the traditional ones.
yeah, right, the traditional ones, yeah, traditional interest rate bearing accounts, and the reason is, as we showed a few weeks ago, that interest rates have been dropping an average of 2.5% per year since 19, I think it's like 40 or 50. They've been dropping for over 30, 40 years on average, 2.5% per year. So the return you've been getting in interest rate bearing account has been dropping by 2.5% on average per year. To today, where a lot of us know now, interest rates today are roughly zero. I mean, you're probably in an online bank if you're getting anything above 1% and 1.5%, because the average interest rate right now in the United States on a savings account is 0.05%. And Brent's a proponent of tells all the time about the rule of 72. And going by the rule of 72 at 0.05%, because so the rule of 72, just real quick, will tell you how long it'll take for your money to double at a certain interest rate. Well, at 0.05%, it'll take over 1,400 years for your money to double. So that's why we're huge proponents of removing money out of traditional interest bearing accounts like bonds, savings accounts, checking accounts, and putting them into things like real estate, the stock market, and a business. And as I said before, the live we did, or the podcast we did a few weeks ago, showed how interest rates have been dropping precipitously the last 40 some odd years, dropping an average of 2.5% per year, whereas the stock market on average returns 10% per year. So that's a net of about 8%. When you're between the two, that if you put your money in the stock market versus a interest bearing account. So today, we're going to show actually tangible examples of how, because we always say, get your money out of interest rate bearing accounts. That's kind of abstract, right? You don't really see the difference between, okay, if I had it at 1% or if I had it at 10%, right? And if we had it, 1%, 10%, if I had $10,000 in there versus, if I had $10,000 in the market or $10,000 in a interest bearing account. So we're going to show you some examples today through a kind of a little spreadsheet Brent has that's dynamic. We're going to be able to plug in different amounts, and you'll be able to see, actually over a certain number of years at a certain interest rate how much you'd make over time.
Yeah.
So we want to show like a tangible example of what we're talking about, and what this is also going to show is going to show why. So the wealth gap really has nothing to do with investment. Well, it probably does. It has probably to do with investments. Really, the wealth gap is created because of pay inequalities. But we always say, at IEA, is that we can't control what people pay us, but we can control how we invest our money. So if we're putting our money into accounts that pay 1% or less, when inflation is typically 2 to 3%, we're losing money every day of the year. Versus putting your money in something that, like the market that returns on average 10% per year. So the reason the wealth gap persists is because African Americans and people of color, typically we have our money in checking accounts, savings accounts, car loans, and personal loans, and all those are negative rate. I'm not negative rates, but we're either paying an interest rate on those, or we're earning less than inflation. So we want to show today actual tangible examples that show you at those low rates over a certain number of years how much you're making, at those higher rates where typically African Americans and people of color don't have their money, how much those people are making. So,
Yeah.
Brett, are you ready?
Yep. And today's going to be very dynamic, and also you can. This is one of those ones you want to share it. You want to ask questions. If you want us to plug in numbers for you, we will plug them in. If you have questions about the fact that where does research come from, we're going to show where the research came from. But the numbers don't lie. And Leon and I always tell you all, if you just take it from a quantitative standpoint, it's the truth. Now, how you invest, the best ways to grow your money is in investments, real estate, stock market, and you're going to building a business. You're going to see that today. but it's going to be shocking what you see. And I hope that you all just stay along with us. Please share this one with friends. Again, this is one of those ones that I know we say it time and time again. This is an important one. And I'm starting to, it sounds like a broken record, but it's true. We talk about stocks all day. We talk about various investments, but the question we get, and especially for those who aren't members of Investing Education Academy, is how do you get those interest rates? And the other question is, well, I don't know what it takes to make $1 million. So it's abstract. And when it's abstract, you really can't place a goal. You kind of just are living your life, right? So we're going to show you the numbers, the data on how to get to $1 million. And it's not going to be stock specific. It's going to be investment rate specific. So today, share, get ready to ask questions. It's going to be a good one. Let me jump in.
Yeah, this one's going to show return on investment. I mean, it's not necessarily interest rates; it's return on investment because you know, a return can come in an interest rate bearing account, or it can come in the stock market. It can come in a business. So we're just showing rates of return over time, and then how much it will grow to over a given number of years.
Okay, and so like we said, this information came from the 2018 Consumer Expenditure Survey. And according to this document, the average savings an American has that they can put their hands on. You're talking between the ages of 25 and 34, having between 14,000 and 28,000 that's the cash equivalent, if you will. Now, some of you all looking at this like, I did not have 14,000 when I was 25 to 34. Some of you all are looking at this like, I've saved more. Some of you all are looking at this thinking that's impossible. So wherever you are, these are just the numbers. We're not saying it's identical to you, but this is the average amount Americans have saved and have access to at these various ages. Between the ages of 34 to 35, 35 to 40, you're looking at between $17,000, $35,000. Between the ages of 41 to 50, you have between 18,000 and 37,000. And this is where you're probably thinking, why is the number going down? But the staircase is still going up, because this is the only graph I can do quickly. So if you look at when you hit the ages 51 to 60, those Americans normally have between 16,000 and 33,000 in savings. What's happening when you get to that age is that children have gone through college, and normally parents have expended a significant amount of money in college. Then you have those who are dealing with their own life issues. And, you know, the fact that they didn't save a lot earlier, they're starting to eat at their savings just to maintain life. 61 to 70, again, you notice the trend goes down. And this is on average. This is the reason why the wealth gap is so huge, because where normally you would think it's going to progressively go up, it doesn't for most Americans. It plateaus between 41 and 50. And that's actually kind of sad, because in that space, that's when, you know, others who have saved and had their money working for them are experiencing the benefits of compound interest. So now, you know, let's move past this. And now those are the numbers. So this is the chart. So money held in a savings account, going back to that chart, if we're talking about a 25 to 34-year-old having, let's just say $16,000.
Hey, bro, we're still seeing the other chart. We're not seeing the.
You're not seeing it? Okay.
No, we're not seeing the spreadsheet yet.
All right. Can you see the spreadsheet? I mean, can you see the chart?
No, you can see the spreadsheet now. Yeah.
This is where you want to get ready to ask your questions. This is where you might want to share this. This is just raw data. It is not biased by investment types. It is just the percentages you need to hit. And if you can notice, I'm starting with, they said 25 to 34-year-olds have about roughly 16,000. I took the average. And in that space, if you have $16,000 at 1% interest, that means by the time you hit 30, if you're at 25, you now have $16,816 after 5 years of your money being in a bank. Again, Leon and I are giving you all an extra 0.5% on the bank side right now. And one of you all have posted how much you had, what your interest rate at your bank was, and you wrote 0.17%. Actually, let me gotta do it the wrong. What was it? 0.017%. Yeah, it just went to zero. Basically, it's in there, but you're looking at in 5 years having $16,014. Let me say that again. If you have your money in a bank account right now, and this, I'm taking this from the feed. Someone listed that this is their interest rate at their bank right now. I plug their number in. In 5 years, if they had $16,000 saved, they would only have $16,014. Now, I don't know about you, but that's just sickening. If they can get to 5%, look at the difference. If they can just get to 5%, they're looking at having 20,400. Let me highlight the $20,421. $20,421. If they can just get to 5%, that is over 4,000 more than what they would have had if they were in a traditional bank. So, Malcolm said this is a mic drop moment. Absolutely. But let's say what happens when you get to 10%. That's a $5,000 jump from there. So now you're almost $10,000 higher or more value in your account just based on where you put the money. The amount hasn't changed at all. We didn't change the amount. We're still talking about $16,000. So now let's get up into the range where anything, according Leon and I believe in Investing Education Academy's thought is anything above 10%, you're moving towards an investment, real estate, or business ownership. So
we'll stock market, real estate, or business ownership. Yeah.
Yes.
Mm-hmm.
So when you can get to 20%, what would have been $16,014 can now possibly be $39,813. Now let's go back to understanding the financial literacy gap. The financial literacy gap means that those who don't know any better, money stays here for most of their lives. It literally never makes it to the top bracket of the next interest rate ever. If they can get to 5%, if they stay in a bank, they never make as much as they would make if they were in a better investment for 2 years. And 5% is still not a great investment. That's kind of horrible. But, we're talking about 5%, and the market has returned since existence. The stock market has returned since its existence 10% year over year. So if you are now in this space and you're even passively investing, you're hopefully earning about 10%. This is big. So now let's go down. Leon talks about time, right? What time does in the market. Leon always talks about what time does in the market. So let's look at time. If you stayed at the 10% level, this is on the low end. And any investor inside of Investing Education Academy will tell you this is on the low end. If you can get 10%, and again, these people are about 25. When they get to 65 years old, they're still knocking on $1 million. If they get to 75, which 75 having 1.8 million is not bad. But we're going to show you what happens if you can just get to 20%. If you take that same $16,000 and you can make it to 20% return on investment year over year, if you can get to 55 years old, you're looking at having roughly $3.8 million.
55 years old is 10 years before retirement.
If you can just get there, we're talking about $3.8 million. And if you can leave that money there for just another 10 years, it goes up to $23,516,345. This is what happens when your money compounds and your money is now an employee and not just something sitting on your dresser, sitting in your drawer, sitting in a bank. this is really important. And this, we're talking about 16,000. We haven't even gotten the real numbers. We're going to plug in real numbers, but we haven't gotten the real numbers right now. So if you can make it to 40%, 30%, if you can make it to 30%, we still have not changed the amount originally invested. 16,000 for a 25-year-old. You're talking about now hitting 45 years old. That's 20 years later. You're sitting on $3 million. If you can get to a place where you're earning 30% or more. Again, everybody watching this, sharing it. I see the shares. Thank you for sharing it. Share it with your family, share it with your friends, but understand these are just the raw numbers. This is the absolute truth. This place is where we all of a sudden don't know how to get to, or we haven't before. If you've been watching Leon and I, if you're a member of Investment Education Academy, you've seen these numbers and more. You've seen these numbers and more. So if you can get to 40%, by the time this individual is 35 years old, they're sitting on almost $500,000. Almost $500,000. By the time they hit 35 years old.
And remember, this is off $16,000. And I don't want to sound, dismissive, but I mean, in the grand scheme of things, $16,000 is not a lot of money. So to grow again, I know that's still, a substantial amount of money, but I'm just saying in the grand scheme of things, $16,000 is not a lot of money. And to grow that to multi-millions of dollars over 20, 30, 40 years is, and again, that's not what we do. Like we're sitting on the left-hand side of this spreadsheet in the 1% or less bucket. And you see the numbers there relative to the 20, 30, 40% side, which is everybody else in America, making that type of money.
So if you're listening to the podcast right now, if you're watching this and you want to say, and you have amount saved or of someone who has an amount saved and you want us to plug in your number, let us know what the number is you want us to plug in. We'll plug it in right now and we'll show you the possibilities, because some of you all are sitting in savings accounts and, it's one thing to hear us talking about it. It's another thing to say these individuals are actually going to show me what's possible for my money. And maybe you've never seen that before. You've never seen what your money can actually do in the marketplace. So we'll show you. Again, if anybody wants to put in a number, it doesn't have to be your number, a number. Okay, so somebody said $5,200. So $5,200. That means, look at this. If you hold that money for 72 years in the bank account as it is right now, you're going to have $5,264. So for everybody listening to the podcast right now, we plugged in $5,200 to see what a person who's in a bank account right now will have in 72 years. And in 72 years, that person will have $5,264.
And what's the rate of that column now? It's what?
No, I'm using this person's own bank account rate right now. It's 0.17%.
0.17. Okay.
So then if this individual can just make it to 5%, that $5,200 at least in 10 years becomes $8,470. Now, let me tell you where the rich lie. The wealthy in the United States, they're normally getting somewhere between, I say 15% and more. Leon, do you think that's accurate?
Yeah, the rich, yeah. But you also gotta look another way too, the people who have money, sitting on multi-millions, don't necessarily need to make 20, 30, 40%, right? They can make 5, like Brent said, 15%, and still make multi-million, because remember that percentage is on a huge number. So they're sitting, I would say anywhere from 5% on up. But again, if you're sitting on $30 million and you're making 5% of that, you're golden. So they don't need to take as much risk. But yeah, generally people that make money in this country their money's working for them, and they're in that, Brent said 15% on up. But the super rich don't necessarily take as much risk, so they'll sit maybe in that 5 to 10% range. And they're not at the 1% to 5% range. No, that they don't live there at all.
And that's also just a portion of their portfolio.
Yeah, right.
They're going to have a portion that's uber aggressive, but the majority is going to be conservatively invested.
Mhm.
So let's say 25,000. So if you have, you know what? Actually, let me go back to 5,200 real quick. I didn't go fully in. So if that $5,200 can get to 20%, if you can get to 20% return year over year, in 20 years, you're sitting on $200,000. So if you hold it for 10 more years, that $5,200, 10 more years at 20%, you have $1 million. And we said today we're going to show you how to get $1 million. This is how you get $1 million. Those people you hear saying, I'm gonna help you make $10,000 a day in, you know, some strange form of investing. If they're making $10,000 a day, they're not training anybody. They're just watching their money grow. And
Right.
if you unless they just want to show, but if you come into one of their networks and they say now you have to pay them to learn this, I don't know. You know that Leon and I, you don't have to schedule some strange appointment or wait till there's a presentation being done for us to give you real facts on how to grow your money. You can show up on these Wednesday live and we show you real ways to increase your money. And it kind of makes me sick when I see people who are like, well, you got to schedule appointments so you can see it all. Well, I can't explain it over email because it wouldn't make sense. I can't explain it to you now because you wouldn't be able to get it all. Why not?
Right.
Why can't you explain it? We can explain why people join Invest in Education Academy because this is something that we normally would show. These are discussions we regularly have. Mm-hmm. This is how we educate our tribe on how not to be in the 0 to 5% range. So again, $5,200, to get to $1 million, you're looking at either getting to 20% and holding it for 30 years or getting to 10% and holding it for roughly 60 years to give, again, how to get to $1 million. All right. Somebody wants to see 100,000. This is going to be fun. This actually blow your mind, but 100,000 invested in a bank account right now is going to yield 101,000 in 72 years. You know what? I'm not even going to leave it at 0. I'm going to take it back to 1 because this is just sad. So I'm going to take it back to 1% because it's going to look better at 1%. No, it took it to 100%, 1%.
0.01.
Yeah, no, it's cool. So at 1%, I had to up it for you. It takes you 72 years to double your money. 72 years. And this is on the compounding effect. So if you can get that $100,000 to 5%, you're looking at $1 million in 50 years. Now, this is where it gets supercharged. If you can get that million to 10%, only 30 years, in only 30 years, which is not a long time. Because for you all who are in your 20s, you're only hitting your 50s. For you all in your 30s, you're only in, and we're talking 30 years, you're only in your 60s. And even for you all who are in your 40s, you're only in your 70s. And it's not all of your money. And that's at 10%. That's doable. So now let's talk about you all who want to get to 20%. You're in the market, you're investing, things are good. There will be ups and downs in the market. Nothing's guaranteed. But if you can get to 20% on a $100,000 investment in less than 20 years, probably about 15 years, you're hitting $1 million. 15 years is not a long time. And I know somebody in Invest in Education Academy that's gotten 25% over the last 3 months. Over the last 3 months. So let's say
I was gonna say on that same point, Brent. I was gonna say so some people may look at this and say, okay, 20%, that's a lot, that's a huge return. How am I gonna get that? I just looked at our stats. So if all you did up until last week and up until today when the market fell apart, up until that point, had you just followed our stop picks on the live, you would have made north of 20%. I think we were like at about 22%. All of our picks from April 1st up through last week had returned an average of 22%, right, per individual stock. And then, but inside of that now, I mean, that's the average. Inside of that, we have one stock, Zoom, is up, I think, like 400 or 500%. We have a bunch of other stocks up well over 50%. We do have a couple losers, but the gains far outweigh the ones that are down. So I'm saying all that to say, just following what Brett and I have talked about since April 1st, just in 6 months, you would have just following those picks, you would have had a return over 20%. So people are thinking about, oh, it's hard to get 20%. No, it's not. We did it through our picks in the middle of a pandemic, in the middle of a market meltdown today, which may continue for who knows how long, and we're still up right about 20%. So 20% is not hard to make, and the market on average returns 10%. But when you pick individual stocks, you really are going to make you can make well north of 30, 40, 50%. I mean, depending on the size of the company, you can do well north of 100%. So the 20%, Brett and I know from experience, it still can be on the low end in the stock market. So making 20%, not hard. Well, it's not hard. It's very achievable. It's very achievable in the stock market if you know what you're doing.
And if you can just get that 100,000 to 30%, which actually I know people on this live right now watching are members of IA, and I know you're over 30%. If you stayed at 30%, again, the market's volatile, but overall, if you were able to achieve something similar, that $100,000 in 20 years could be worth $19 million. $19 million. So let's say we have a really good spurt and we can get years of prosper, stock returns, and we get somewhere in the area of 40%. Well, if you can get to 40%, you only need to have 10 good years to get to $3 million. You only need 10 good years to get to $3 million, or just under 3 million. So somebody asked about 40,000. Oh, and let me show you this before I go on. The average amount spent per kid each year for Christmas is over $500. And parents, this is a great one for all you parents who know other parents. Please share this. And we buy our girls 2 presents every Christmas. 2 presents. And we've had people like, why do you only get 2 things? Why are you on? Because I don't want my kids growing up being consumers. I don't want my kids growing up thinking that it's like cool to buy stuff, to spend money on clothes and shoes and things that really don't matter. I want them growing up reading this chart. I want them growing up looking for investments to get a high rate of return. If the average parent is spending $500 or more on your kid for Christmas, that means if you were to just put that money into an investment account, maybe not get them as much. In 20 years, if you can get them to 20% for a child, that's very doable. Very doable. Mm-hmm. Very doable. My daughter's account right now is at 43% rate of return, and she's 8 years old. My youngest is 4, and I want to say her account is at 27% rate of return. It's very doable. And if you can take that 500, this is just one time, and invest that 500, and by the time they turn, if they're, let's say, 5 years old, by the time they turn 25, you will be giving them a gift of $19,000. It's almost $20,000. This essentially can be their down payment for a house. Mm-hmm. If you can get to 30%, which we've explained is doable, you then, at the time they're graduating from college or starting their young adult life, you could turn over roughly $95,000 to them. And if you are lucky enough to get to a place and wise enough, and you have the right strategy, and you make it to 40%, you're looking at giving them a check for $418,000. This happens. It is not something that's never happened before.
So, and as I said, as I just said, if you just followed our stock pick since April 1st, when we actually officially started, you would have roughly between 20-25% rate of return. Now, as of today, we're a little south of 20% because the market was down like 3% today. So I think we're like at 17, 18%. But that's including the dip, right? That's including the most recent dip. That's including all the volatility we've had since April 1st with the market. And we were still up, 20 to 25%. So the point is making north of 20% in the stock market is very, very doable. I would venture to say that really that 40 to 50% or more it is doable. I don't want to make it sound like it's easy, but it's very, very doable if you stick to a strategy, pick quality companies, and also pick companies that pay dividends, because that then pads your gains. So yeah, these returns are very doable. It's just we as a community often don't talk about this. We don't share this type of information. We don't even know this type of information.
Yeah.
That's why we want to definitely show like tangible examples of this today.
And I have 3 members in my family alone who are over 100% rate of return over the last. One has been at about 90% rate of return for the last 7 years. Another has been at about 70% rate of return for the last 2 years. Another has been at about between 80 and 62% rate of return for the last 2 years. So these numbers are doable. And we are bringing you all this information because nobody ever told us when we were young. Nobody told us this was doable. Nobody told us how to do it. And for those of you all who, again, are members, you've seen some of the posts that have gone up in the last 2 weeks about stocks that have had 30% runs this week, 22% runs this week. So this is for Christmas is coming up. And I pray that this is burned into your memory when you go out and buy a whole bunch of toys that your kids are going to use for like a month or 2 months or 3 months. And
they may play with the box more than the toy.
Right. Or, a lot of times we get gifts because of us. The kids don't care. Like the kid gets as excited as we're going to get. So if we get overly excited about the wrong things, and this is totally my thoughts, every family's different. If you get excited about things that the kids really don't need to be excited about, they'll get excited too. If you get excited because you were like, look, we wrapped up a crayon drawing of a stock certificate of what we put into your account, we're going to hang this on the wall, we're going to frame it, you make it a big deal, the kid will make it a big deal. It's your choice to make the new shoes or some clothes or sweater the big thing. It just doesn't need to be it. So this is the amount spent per kid each Christmas, right?
On average.
The average amount spent per kid on clothes between the first 5 years of their life is $3,600. One of our watchers, viewers right now, she said her kids love playing with the boxes.
I told you, I remember my nephews were young, dude, all about the box. The toy went under the couch after like a day. It was all about the box.
For the first 5 years, on average, Americans spend about $3,600, and that's really low, but that was the average, so we're gonna go with it, right? If you had an alternative means to maybe do something else, get clothes from a cousin, to get hand-me-downs from family members, whatever, I do that. I have my cousins all know when they grow out of it, they give it to me, my wife and I. We wash it, Ziploc it, write the age that the girls were on at the time they gave us the bag. We put it in the closet, and when our daughters hit that age, we just pull the bag off the shelf. We let the Ziploc lining go, and we put it in their drawers. And they've been happy as I don't know what. And they just I joke and I say that my kids talk about their cousins as if they're brands of clothes. So my girls will say, "Are you wearing Avery?" And the little one's like, "Yeah." And she's like, "Who are you wearing?" And then the older one's like, "I'm wearing Sydney." And then the younger one's like, "Okay, tomorrow I'm gonna wear Taylor." And like they're naming their cousins' clothes as if it's talking about like Gucci and Fendi or something, because that's all they know. And it is exciting for them to know they're wearing something that their cousins also had. And
but they didn't spend Gucci or Fendi money.
Yeah, but they literally talk about it.
Mhm.
And it's kind of cool to see, like, I remember where, you know, Sydney was, my niece was in that, and now my girls are wearing it.
Mhm.
So, you know, maybe when they hit teenage years, that's something different. But you know what? If we do this now, when they turn into teenagers, they'll be using their investment proceeds to buy that stuff. Not my money, not their actual money, but the proceeds from the investments that we made when they were young to buy that stuff that they really, I could care less about when they turn into teenagers. But I will absolutely allow them to buy it because they sacrificed when they were younger to live that life when they turn to teenagers. They already are talking about the cars they're going to buy because they know they have enough to buy a car right now, and they're 8 and 4. And so it's really, we want you all to have a different relationship with money. And we're not saying this to say we're doing it right. We're not saying this to say, oh, this is the way everybody should live. We're simply saying these are some things that we've done that work. And we did it because we didn't have a lot of money, not because we were swimming in it. And I was determined that my girls, instead of me not having it and being like, well, I want them to have everything I don't, I'm like, well, no, let's make sure you have a lifestyle that never caused you to go through some of the things I went through as an adult. And I've literally heard parents out there say things like, well, I don't want my kids to grow up spoiled, or I didn't have it, so why should they? And for anybody that says that, if it ever came out your mouth, shame on you. Because if you don't want your kids to have a better life than you really should reflect on being a parent. Like, that's for me. Send me an inbox. Tell me how you feel. Now, if the average amount spent on kids' clothes the first 5 years of their life is $3,600, if we could find a way to get that into an investment, by the time that kid turned 45, they could have $5,291,000. I'm gonna go straight to it. At 20% interest, if you can just find a way not to do that and to get them the $3,600 into an investment as early as possible, you're talking about your kids by the time they turn 45 having $5,291,000. If you can,
$5 million. I mean, just think $5 million at 45 for doing essentially no work for it. Now, of course, the money was invested. You had to make the money, yada yada yada. But essentially, that money grew for that amount of time by doing nothing. And you have $5 million in 20 years.
And really, let's just keep it simple. If you only get 10%, you still can write them a check for $162,000.
Yep.
So yeah, it's not 5 million, but 160. Imagine anybody watching this in their 40s or 30s, and imagine, close your eyes for a minute and imagine your parents calling you tomorrow and saying, oh, I forgot to tell you, I had this investment account I set up when you were young. Where should I write this check for $162,000?
Right.
What does that do for your life? What does that do for your stress level? Because you know what happens then? You take 162,000. Let me go back to the other one. 162, and you invest it. And even if you're in your 40s when you receive it, and you can keep it in just to your 50, from 40 to 50, and get another 10%, they've now given you $420,000 essentially. If you can take that 162 that they called you at 30 and said you have, and you invested at 10%, and you just make it to 50, you have $1 million. And again, today we said we're going to show you how to get to $1 million. This is how you get to $1 million. If you can take that 162 and get to 20% rate of return, in 10 years, you will have $1 million. If you can get to 30%, in 10 years, you have $2,200,000 because somebody didn't spend $3,600.
And so next time anyone you hear someone say they're gonna, they made, and not saying people don't, but when people out here, online with all this crap out here saying, oh, they made $1 million in 6 months, they made $1 million in X amount of time. Now you can kind of go back in the back of your head and say, okay, to make that type of money that short amount of time, they'd have to make X amount on their money, right? And we know that the market returns on average 10% per year, but as we said, with individual stocks, you can earn 40, 50, 60, 70%. If somebody's talking about they made $1 million in 6 months, 3 months, 12 months, even a year, based on rates of return, that's most likely BS. Unless, and the way it probably isn't, is that they had a lot of money already. If they were sitting on already $1 million, if they were sitting on $500,000, that sort of thing, they wouldn't necessarily need the higher rate of return. But generally, as Brent said, we're showing you how to make $1 million legitly. Like this isn't our opinion. This isn't how we feel. These are the hard facts, the hard numbers, and this is how people really become millionaires, versus scamming and crypto trading and Amazon FBA. Not saying it can't happen, but it's very rare. As we're showing here, it does take time. I mean, we're talking 10, 20, 30, 40 years, but it can happen. And if you up your rate of return, which, as we said, is definitely possible in the stock market, you can get these types of returns.
Yeah, and also if you do have a business and you're thinking about pricing models and you're trying to figure out how do you price, and when you know this type of information, and we're going to make this this spreadsheet available inside the IEA platform to our members. So just everybody know this will be made available to you so you can plug in your own numbers. When you know this information and you're talking about pricing for a business, you start to think, well, I should price in a 30% profit margin. I should price in a 20% profit margin, because you know what that can yield in the future. This gives you the ability to make business-driven decisions based on data. And so, I mean, we wanted to bring it to you all because it's necessary. And we can go through all day. And if anybody has any numbers, $40,000. Okay, so we're going to plug in $40,000. And if anybody else has an interest rate they want to see, it's dynamic. We can plug in various interest rates. Let's see. So $40,000, let's go to the good stuff, right? How do you get to $1 million? If you have $40,000 and you have it in an investment account from at 5%, in 72 years, you'll be at $1 million. So $40,000 in 72 years at 5% will be $1,341,805. If you can get that $40,000 to 10%, in 40 years, you'll have $1,810,370. If you can get that $40,000 to 20%, in 20 years, you have 1.5 million. Again, if you can get the 40 to 30%, in 20 years, you're sitting on $7 million. It almost seems fake, right? Like, no, that can't be right. Compounded interest is the most amazing thing ever created, because your money becomes your workforce, not you. And if you don't know how to make your money good workers, then go ahead, Lee.
I think it was Albert Einstein who said, compound interest is the 8th wonder of the world, I believe. We're talking about Albert Einstein here, the genius of all time. He even saw, back in the 40s, 50s, he made a comment that compound interest is the 8th or 9th wonder of the world. Like, he saw the power of compound interest. What we're showing you here is compound interest. It's passive income, and it is doable. Like I said, we are just the stock picks that Brent and I have made over the last 6 months have returned on average north of 20%, between 20 and 25% in 6 months. The next 6 months, could that drop? Of course. Could it go higher? Yes, it could. But what we're saying is we've experienced, just from our stock picks on here, that we've achieved north of 20%. So if you do that over the next 30, 40 years, I mean, as Brent showed, you can be a millionaire.
Yeah, and I told you one. So Leon and I have started talking to. We do family Zooms, and so we actually talk to families about this and understanding money, because not everybody's going to join IEA, and some people have wanted to hire us to talk to their family via Zoom about ways they can actually start creating generational wealth. So we show charts like this. We talk about life insurance. We talk about the market in detail. We talk about understanding bank accounts and credit. All these things are very important because they all reflect on how you have a relationship with money. And so I told you, we know somebody right now who's doing 62% per year. Well, for the last 2 years, they've done over 62%. So it didn't even accept I have to make the column bigger after 72 years. That's crazy. So at $40,000, and they have more than 40,000. So I'm gonna put in, it's like 123. So at 123,000 in 20 years for them, they'll be looking at roughly $4.7 million if they can go down to 20%.
Mm-hmm.
If they can go down to 20%. If they can, and they're not going to stay at 62%. That's just crazy.
That's not.
We're having a good run. But so if they can just ride that for, let's say, 10 years, and they can get 761,000. But what happens is, once you take that 761,000 and you invest it, now they just need to stay in the 10% range. And at 10%, it's going to continue to grow for the next 5 years. And over 5 more years, they're going to be at $1 million.
Mm-hmm.
So even if their interest rate gets cut in half, their return on investment gets cut in half, they're still sitting on $1 million. And again, today we told you, we're going to show you how to get to $1 million. We're not going to show you how to scam your way to $1 million. We're not going to show you how to lie to $1 million. We're not going to show you this get rich quick scheme. This is just interest rates. How you achieve it is really, we choose the stock market for our vehicle. Starting a business is equally as effective. Real estate, you can have some really good runs, but we've had real estate investors on, and we know the rate of return can sometimes be between 6 and 8% year over year, because of the time it takes to fix up a house, how many people sometimes you have to split up the profits with, and then also considering all the bills to get a house ready for resale. But we also know that those who are in the real estate game and killing it, they're getting pops over and over again. They're getting those high dollar pops. That's not everybody, but that is one of the better ways to make money. Business, there's a lot of businesses that fail. You have to have the proper team in place, giving you good counsel on how to build a business. And I know some of you all are looking at these charts saying, well, why aren't they talking about the $1 billion accounts? Because we should some of us don't even know that we can get to the millions.
Some of us don't even know we can earn 5%.
Right.
I mean, like I said, the live we did a couple months ago showed how African Americans and people of color, our money generally over our lifetime earns no more than inflation. So our money literally loses money every day for a lifetime. Loses its buying power every day for a lifetime because our money sits at 1%. So $1 billion, I mean, that's, we can't even get there yet. We got to at least get up to 10% first.
Yeah. So we just wanted to share this information with you all, with everyone. We really hope it was useful information to you all. If anyone has any additional questions or interest rate they want to see plugged in while we get ready to give you all our stock picks, just let us know. But if you're listening to our podcast, if you're watching us live, understand the reasons why we're so passionate about giving you all this information is we're not talking about it enough. And if people do talk about it, it's behind the paywall. Leon and I have a membership platform which is behind a paywall. We still bring you all this information because we just want you to know. We want you to share these lives, sit down with your family, talk about it. Because if you're in the 1-5% space, you're losing. Mm-hmm. And unless you're investing multiple millions of dollars in that framework, you are losing. You're losing money. And I don't mean like loser type name calling. I mean, you're actually losing money at the 1% space, at the 2% space, at the 3% space. 4 or 5%, you're just not doing that great. But you're not losing like you would between the 0 and 3% space. So if you are one of those individuals who are saving inside of a traditional savings account, or you're looking at traditional bonds or certificates of deposit at your bank, and it's paying you less than 3%, please just be an educated consumer and manager of your money and know that you are losing on those investments. The banks are making up because they're using your money to make more money.
Big time. And this year of COVID, like I said, we say inflation averages 2 to 3% per year. This year, inflation is the estimates are anywhere from 5 to 10%. So even if you're making not gonna go that. If you're making 2% on your money right now in a savings account, that's typically you're breaking even with inflation. So you're not losing, but you're not winning. This year, you're actually losing money because inflation is really running anywhere from 5 to 10%. And that varies between real estate and cars and gas and food. But they say on average this year it's been about 5 to 10%. So I mean, unless your money, and then think about that. Brent and I's bread and butter is the stock market, right? We know on average the market returns 10% per year. This year alone, if you're making 10%, if you're making the market average, you're still only about breaking even with inflation because inflation is running rampant this year because of all the supply and demand effects going on in the economy right now with certain goods, namely groceries, cars, and real estate. So you're only breaking even with the market, right? And this is an anomaly of a year. This isn't normal. And that's what I'm saying. Even for that, you want to make in individual stocks, you make 20, 30, 40%. So as I said, our picks through last week, we were north of 20%. So we were beating inflation, which is great. As of today, we're a little below 20% because the market corrected today about 3 to 4%. But again, we're still well above the 5 to 10% inflation because we put our money into the stock market. So
we're at 16.25% rate of return.
It's like 16% return right now on average for the stocks we've picked since April. Just want to make that point that we got to get our money out of we have to get our investment money. I'm not gonna say all our money. Get our investment money out of savings accounts, out of interest-bearing accounts, and put them into things that give you a higher rate of return, like the stock market, like real estate, and like owning a business.
All right. So with it, we owe you all the stock picks. So Leon, what is your stock pick for today?
So mine today is a company called Workday. Workday, ticker symbol is WDAY. Today closed at $209.70, and it was down 2%. So Workday, I have some experience with Workday. So when I worked at Accenture, Workday provides human resources and financial tools to big corporations. And when I was at Accenture working there, the HR tool we used inside Accenture was Workday. So I've actually used Workday. I know it works. I know it's a fairly decent tool. But they have a lot of big clients. They have quite a few Fortune 500 company clients. And Accenture was one of them when I worked there. So again, they provide HR software and financial services software via the cloud to big companies. Over the last 3 years, their average sales have grown per year at 32%, and their average profits have grown at 10% per year on average over the last 3 years. So that's my pick today. Workday, ticker symbol WDAY.
All right, and it looks like it says it's from the former founders of PeopleSoft.
Yes. Yep. Yeah.
That is always a win.
Mm-hmm.
For me, I am capitalizing on the fact that the market is depressed today. And so I'm picking Salesforce. Recently, Salesforce has been just on a tear with acquisition type behavior. And that means they've been buying up shares of other companies. And they were really big in the Snowflake deal. I think they got 230 million.
Yeah, them and Warren Buffett bought 200. Yeah, I believe it was 230 or 250 million at the IPO price. Yep.
Yep. So Salesforce within itself is cloud-based software. But what I like the most is the fact that cloud-based software is growing hand over fist. You can't deny it. And mostly anybody in the cloud-based space is going through Amazon, Google, or Microsoft. And there being no exception. It puts them on a very stable platform to, hedge against the fact of them crashing or the infrastructure coming down around them. The market they're selling currently, their ticker symbol is CRM. It's Salesforce.com. Their ticker symbol again is CRM. They're trading right now at $238 per share. They're down 4.75%, equaling being down $11.87. And for anybody who doesn't know how to read this, and I've recently learned that not everybody knows when Leon and I are giving you these picks, what we're reading. This is the name of the company right here, Salesforce.com Inc. That's literally the name. Right here where you see this CRM, that is called a ticker symbol. That is a symbol by which you would actually buy the stock inside of your brokerage account. For those of you all who are like, this is elementary, trust me, it isn't. Not everyone knows this. When you see this number right here, this is in USD, that means in US dollars. This is how much the stock is trading at right now. It's trading, or at the close of business today, is at $238.43 in United States dollars. It is down today minus 11.87. That means it's down per share $11.87. And that equals being down about 4.74%. So that's how you read that. You know, some of you all have sent us messages, made us aware that Leon and I kind of breezed through it, and you don't know what it means. So there you go. I really like Salesforce because of their acquisition model. You can see their growth. Their market cap is over $200 billion, which means they're not going anywhere anytime soon. And also, when companies have market caps in the billions, I like the fact that it means they can contribute a lot of money towards research and development. Research and development is what keeps most companies moving forward, especially when you're looking in the tech sector. So again, Salesforce.com is a cloud-based software company, and that is my pick for today. Leon's pick is Workday, and the symbol was WDAY. Workday Inc. WDAY. We really want to thank all of you all for, you know, the continued support, and we're realizing how many of you all actually share these videos after they're done. That means hopefully that you're sharing it with your family, you're sharing it with your loved ones, because again, there are a lot of people who are putting this type of information behind the paywall, and we do want to grow Investment Education Academy, but we want to provide this information more than anything else. Anybody who saw the spreadsheet today that we used, we will make that available to insiders and Panthers inside of the Investment Education Academy. It actually came with their, it comes with your membership. And so we have, for all insiders, there's a tab that includes all of the worksheets and other things that we've created at your disposal. This will be no different. It'll be in by this weekend. And for everybody watching, it's just kind of a cool thing. We have a Panther meeting coming up this Friday, and it's going to be the first time where we're looking at buying international land. So I'm actually super excited about the prospects of buying land on foreign soil. And we have a number of Panthers who I'm pretty sure are going to make the purchase. And Leon and I, as IEA, might be making the purchase to acquire land as well as an investment for IEA. And I say that for this reason. There are ways to be involved with people who are making moves and trying to get beyond the 40% rate of return. And there are communities, and it doesn't have to be just ours, but sometimes people think it doesn't happen. And that's why I'm saying this. It does happen. Will it work in our advantage? I hope so. Is it a guarantee? No. That's why in the earlier part of the conversation for the Panthers this Sunday, we're going to be talking about creating how would you say it, Leon?
What's that?
The fund.
Oh, yeah. I mean, do you want to?
All right. We're working on something that could be big. And so it could be like really big. And I mean, it's just really cool to grow with some of these people in this group. And I thank all of you all for being supportive, and life is changing for everybody involved. And we're getting your stories. So please continue to share your stories with us about interest rates that you got sometimes when you had a loss, because then we can share with other people so they can see loss is part of it too. Just 2-3 days ago, our portfolio was up 23%. It's now up 16%. But you know what? It's still more than 10%.
Mm-hmm. And that's 16% in 6 months.
Yeah.
Stock market on average returns 10% per year. So we're beating the market. We were beating the market. We basically doubled the market's return that the market typically returns annually. We doubled that in 6 months. And that was just picking, picks your own live. So, again, that's with research and stuff that we've done in the background. But we're just making the point that it's very, very, very doable to make 20, 30, 40, north of 100% per year in the stock market if you pick the right companies and you know what you're doing. It's wholly possible. And join things like IEA or any, I don't know, Tony Robbins or whatever else is out there with a community of like-minded investors where you can share these ideas and be made aware of these investment opportunities.
Yeah, and if you're looking to grow your money, don't be cheap about it. Like if you need to invest in yourself, invest in yourself. Don't try to find the cheapest way to do it. You know, it's investing in education. I mean, like if you want to get some education on it, if you want to take a course, if you want to find out more about, you know, how does this market thing work, whether it's us or somewhere else, invest in yourself. If your entertainment budget is bigger than your education budget, at some point in time, the people who are investing in their education are going to beat you. And it almost doesn't matter how much you make because they're going to catch up. And so just live the best life you can, invest when you can, and only use risk capital. Don't go out there swinging for the fences and, you know, losing money. And we're going into a political year. Please go back and watch the video. Leon did a lot of research in regards to what happens during political election years. We're about to hit that real rough patch before the election, and it's gonna be up and down. It's not just gonna be all down, but there are gonna be some great buying opportunities, and there are gonna be some points where you just need to buckle in and just ride it out. So don't feel like, oh my gosh, this market is crazy, I'm out, because as Leon's graph showed, no matter who's in office, over the long run, the market usually is lower left, upper right. This is just a rough patch to get us through. It toughens us up. It teaches us more about how to stay the course in the market. And that's important to know because no one else is telling you that. And all these people like, oh, the market's gonna crash, get out. If you want to listen to them, that's your choice. I'm not. And I, you know, I don't even have the energy to try to convince everybody that that's not the best thing to do. But we're showing you hard evidence that you're not serving yourself well by running the other way.
And just on that point, I just want to make one last point on this before we go, because I know we're kind of rambling on here. But the last point I want to make is that think about, like, today the market was down 3 to 4%, right? A lot of people were like, oh, you know, going to zero, like always, people panic. But think about it. What's changed between today and last week when the market was up whatever percent, or when the market topped out on, I believe it was September 2nd, topped out there, right? If you go back and look at your portfolio, look at your companies, and some of them may have reported earnings, some may haven't, but look at the fundamentals of the company: sales, profits, market share, the big three. Has anything changed between last week and today? The market was down 3 to 4% today. Has anything changed for Microsoft since last week? No. The market sold off, yes, but the company's fundamentals have not changed. And as we've shown in the past, when these dips happen, people that are in the know, they know to buy these dips. And again, not your whole portfolio, not all your money. Again, risk capital, you can even take small bites and dollar cost average in, but these are buying opportunities for quality companies. So just know that. Just, yeah, I mean, like I said, Brent said, anybody telling you to get out and sell all your positions, let them take care of that. You want to do, in some ways, you want to do the exact opposite and start buying quality companies at discounted prices.
Yeah. And don't forget, get out and vote. The election.
Oh, yeah, get out and vote. Yes, yes.
November 4th is right around the corner. Get out and vote. Everybody, we thank you for your time, and we will see you on the next Wednesday. And actually, let me see. Next Wednesday will be the 4th. So that'll be a fun one. So November 4th.
It's the day after the election. So.
Yeah. So we will see you on November the 4th. And thank you again for being with us. Have a great day.